All what the stock market cares about right now is rate cuts. They're fixated on rate cuts. The Fed is going to cut rates for fill in the blank reason. And that's going to be good for the economy, but most importantly, good for the stock market. Of course, we all know that back in 2007, the Fed was cutting rates, and they did so in 2008, and that did not help. But what is the best route right now for the bulls? To find the rate cut and win, because we have three different outlooks in the economy right now. We have the soft landing outlook that, hey, inflation is going to go down on its own. We're not going to see significant damage in the economy. The jobs market will remain intact and the Fed will back off and everybody's going to live happily ever after. And then you got the stagflation camp, which is my camp. We say, look, inflation is cooling off, but it's not going to go down to the target and it will continue to rebound over and over and over. And the Fed will have to raise rates significantly until something breaks or induce a recession. Then you got camp number 3 that says, no stagflation. We're going to go to recession right away. Matter of fact, inflation is not just cooling down, it is crashing. And it is crashing for the wrong reasons. Which one of these routes, the bulls will find the rate cuts and they will end up being alive? They'll win. The answer is, how about the soft landing route? Because in this route, inflation goes down to the 2% target, no damage to the economy, Fed backs off, boom, you win. This was the route that the bulls were on, let's say year to date. Some would argue since the November or October bottom. The theory goes, inflation is cooling off, no damage to the economy, the Fed will start pausing or cutting rates as soon as possible. And then we got more inflation data, as you recall, the jobs data, retail sales, inflation data, all pointing out that the fight is not over and inflation is rebounding significantly higher and the Fed will have to do more. And immediately, the stock market took a leg down and the rally was looking shaky. And in my opinion, we should have been talking about revisiting the October bottom right now as we speak. And the reason is the bulls die right away the moment they hop in the stagflation route because there's a big bear waiting right there. If we get any outlook, this is going to be stagflationary, the bull loses right away. But then came the SVB collapse. And we started talking about, forget about stagflation. With the banking crisis, with the tightening of credit conditions, we're going to go to a recession right away. The problem with this route is it gives the bulls the illusion of winning because the bear is not there right away in this route. The bear appears as you get closer and closer to the recession. So the bulls can run in this route and appear to be winning and feel like they're winning. And the reason is, Fed rate cuts appear to be more likely. I mean, I have this screenshot from back in 2020. The April payrolls, the economy lost over 20 million jobs. And immediately, stock futures blasted higher. I think most of you recall all of this. But back then, the Fed was actually easing and stimulating the economy. An economy, by the way, that did not need stimulation. An economy that was wounded artificially due to the Great Panic of 2020. So the recession crowd would argue and say, hey, bulls are getting too excited here. The bear is waiting down the road. You're going to get ambushed. You're going to get killed. Case in point, here's a tweet from Northman Trader. He says, fun fact, when they intervened with Bear Stearns in 2008, the same weekend as SVG this year, by the way, SPX rallied 14.5% and the VIX got crushed from 36 to 16. Everything was contained, they told everyone. It was not. So this is what the recession crowd would say. You're getting the illusion that, oh, you have a banking crisis and you have a recession threat that is getting bigger and bigger by the day, so the Fed will react by cutting rates, and that's supposed to solve the problem. In reality, it won't. Now, let's step back to the stagflation crowd. What evidence do we have here in the stagflation case? Because the counter goes, hey, Maverick, what about the CPI, the PPI? They're all showing that inflation is going down. Are you out of your mind expecting that inflation will rebound higher again or stick? Inflation is actually getting crushed. Well, not really. In the aftermath of the CPI, we'll look at the Wall Street Journal survey of economists, look at the January trend versus the April trend. The expectations were by June 23, the CPI would be below 4%. Now they say it's going to be above 4%. When the economists were asked, hey, when do you expect the Federal Reserve to make its next rate cut? In the January survey, the majority said in Q4 of 23, meaning this year. In the latest survey, they say it's going to be Q1 24. And in next month's survey, they're going to go, oh, but Q2 24, 25, when we get the rate cuts. And of course, these economists are always always late to the recession. They only acknowledged that we have a recession after it already started. Before the recession, only 40% of economists, actually less, said we're going to have a recession in the next 12 months. This is back in 07, 09. Right now, we have a little over 60% who say we're going to have a recession in the next 12 months. And as the market rallies, these expectations continue to go down. And they're only going to realize that we're going to have a recession after the fact. I want you to listen to Mohamed Al-Arian because today he said something really important about the stagflation theme. Take a look.
Joe and I were talking with Andrew earlier this morning just about how it's surprising to see yields that are higher given the weaker than expected inflation data that was out there. That would make you think that the Fed is getting near the end of the rate hikes and maybe as a result, yields would come back down a little. What happened?
So two things happened. One is core inflation was not weaker than expected at 5.6%, and that's the one to look at. And second, flying under the radar screen are survey measures of inflation. You had the New York Fed last week showing that inflation expectations for this year have gone up a full 0.5 percentage point. You had the Wall Street Journal this morning surveying economists. That's up 0.4 percentage points. So what you're getting is recognition that inflation is going to be sticky at around 4 to 5%. And that's what's been reflected in the 2-year that has traded back up to 4.14 and higher expectations of a 25 basis points hike at the beginning of May.
You think that it's going to be stickier, too?
Oh, absolutely. I mean, I've been saying this for a while, that if you look at how inflation has migrated from a few goods, food and energy, up to the whole goods complex, and now to the service complex, and we're starting to see it in wages. People should follow the Atlanta Fed wage tracker. That's up around 6%. So if you look at what has happened to the inflation dynamics, it's now embedded in the service sector, and it's starting to impact wages. And that's what happens when the Fed is late. That's what has happened in past episode, is that inflation goes from things that are interest rate sensitive to things that are less interest rate sensitive.
So again, in my opinion, he's spot on. This is stagflation. You cannot say that inflation is dead. The Fed is way too late. Inflation is now embedded in the expectations among consumers, not just in the New York Fed survey, but also in the University of Michigan survey. And we talked numerous times ad nauseum in this channel. You cannot defeat inflation without defeating the aggregate demand in the economy. You cannot defeat the aggregate demand in the economy without inducing higher unemployment. This is the only way we know. Show me another way to kill the aggregate demand, I'll tell you, okay, we have a soft landing coming. But this is perhaps the most important part that Mohamed Al-Arian touched on today. Take a look.
Meaning even if they hike rates further, it's not going to have that much impact?
You need to go higher and for longer, and therefore you incur two risks that we've talked about. One is to the real economy, and the other one is to the financial system.
So again, it appears that Mohamed Al-Arian is in the stagflation camp. That, hey, to resolve all of this, you're going to live with stickier inflation, higher inflation for longer. And the Fed will have to raise rates for longer. And the inevitable destination of all of this is a recession, be it with a financial crisis, something breaks, or organically by higher unemployment.